الله الرحمن الرحيم. اللقاء الفات احنا حكينا على التاكسيشن. we defined the income tax and the marginal tax. Okay, try to do the examples and the questions in your handbook. It's important. Fine. Today I'm going to talk about the balance sheets and the accounts related to the balance sheets. Okay. So now, what is the balance sheet? Yes.
The snapshot of the financial position on a specific date.
In a specific dates or period of time, because it is now picture. Let's see, as she said, which is totally right, is a snapshot now. It's taking a snapshot of the financial position. Let's see, for example, if I take a picture now for this class, this picture will change after 1 second.
Yes.
If I take another picture, a new picture, it doesn't match with the previous one. So the financial statement, including the balance sheets, is giving exactly what is the financial position now. Okay, what is the difference between the balance sheets and the income statement? Yes, raise your voice.
The income statement contains the revenue and the expense and the profit of the corporation or the firm. But for the balance sheet, it contains the assets, the liabilities.
In terms of time?
In time, the income statement is for a period of time.
Yeah, covers for 1 year, for instance, or 1 quarter.
Balance sheet, it's at a date of time, specific date.
Yes, now or a particular. Yes, you are right. So the balance sheet is giving you the picture of the financial position at a particular point of time. However, the income statement gives you the result of the business for the previous year or the previous quarter. There's a big difference between the balance sheet and the income statement. Okay, generally speaking, the balance sheets represented by the T account.
Yeah.
So in your left-hand side, you have assets, and your right-hand side, you have liabilities.
And equity.
Okay? Just to give more names for the assets is the uses of funds, and this is the sources of funds. Okay. We divided the balance sheets into quarter, like this. So here we have the current assets, and here we have the fixed assets. And here we have short-term liabilities, or let's see, current liabilities. Current liabilities. And we divided for this for two. The long-term liabilities and equity and shareholders. Okay? This is the things. And we can represent this T account by using this formula. Total assets equal total
liabilities.
or let's see, not total liability, total liabilities plus the shareholder equity. Equity, fine. So this is the formula. So the shareholder equity in this case is equal total assets minus total liabilities. Okay? So this part is equal this part minus this part. So equity is equal total assets minus total liabilities. Total liabilities includes the current liabilities plus the long-term liabilities. Okay? Let's go back to the current liabilities. Before talking about the current liabilities, the transactions of the balance sheets is recorded according to the historical value. Yeah. Okay, don't forget the historical value. Historical value. What it means is recorded based on the historical value. It means, yes?
Record assets at their cost.
At their cost. What about current assets or cash?
The period that will convert into cash.
Yes? Yeah. In exception of this, you are right, but just to redefine this, historical value, all of the transactions in the balance sheets are recorded based on the historical value, in exception to the cash. Because cash is cash. What is the historical value of $100? It is $100. In exception of cash, all of the transactions in the historical value is recorded into the historical value. What is the implication of this? The implication, sometimes the balance sheet is not reflecting the reality of the business. This is one of the disadvantages of looking at the balance sheets. For instance, if you look at here the fixed assets, the machine is now, see for instance, $50,000. Look at the machine. The machine is $50,000 now. Or let's see the building or the machine. The building is $70,000. Now let's focus at the building. This is recorded according to the historical value. The building is recorded according to the historical value, deducted from it the depreciation. Fine? Now let's focus on the building. Just to digest what is the importance of the historical value. So the value of the building is $70,000 after the depreciation. What is depreciation? Why depreciation is important?
Because it will decrease the price of the
Yeah, because the asset is wearing out.
Yes.
Okay? So the value of the asset decrease over the time, which is fine. On this, the business or the managers, they should think that after a period of time, they have to buy a new building or a new machine. Okay, so now is $70,000. This after the depreciation. After the depreciation. Maybe this one is bought or was bought in before 3 years. And the value of this was $100,000. And is depreciated for 10 years. 1, 2, 3, 4, 5, till 10 years. So each year we have to depreciate 10,000. This is for 3 years. 100,000. So we deduct 10 for each year. Till today, $70,000. Okay? So it means after 10 years, we will have $100,000, thinking that we will buy a new building. This is the idea of depreciation. Now, this is not the story now. My question is now, today, according to our book value, which is the historical value, so the new building here, $70,000. If you look at this is the book value. Book value, it is the same of the historical value. But the problem, if we look at the market value of the business, of the building, maybe the market value is $150,000, which is different. So this is the problem in the balance sheet. In the balance sheet, we are recorded transactions based on the historical value, not based on the market value. Okay? So the balance sheet is not giving you what is the actual financial position of this business. Okay. Now, as I explained, the balance sheets, this is total assets and this is total liabilities. And as we divided them for 3 sections in the liabilities and 2 sections in the total assets. The total assets includes the current assets and the long-term assets, fixed assets. The current assets includes the most liquid assets, which is short-term assets. Okay? So these are short-term assets. Short assets. Or let's see, liquid assets comparing with the long-term assets. So what it means liquid here. What it means liquid. Some people saying something. Okay. The easy to convert asset into cash, right? But this is not the, let's say, the full definition of this. You are right. Is the speed in which you can convert asset into cash. That's fine. Without the changes on the price. Yeah, without changes or with no implications on the value of the assets. Or significant implications on the value of the assets. Let's see, for example, give you just very, very little example here. If you have to see what it means liquidity. If you have 2 mobile phones, okay, 2 mobile phones, the one for Galaxy, Samsung, and the one for Sony Ericsson. And you decided to sell them. Which is you can sell easier than the other Galaxy? So it's more liquid. You can easily sell Galaxy into the market without implications on the price. But if you want to sell Sony, you can do this, but you may need to wait for a longer time, and it may influence on the price of Sony. Yeah. Why this? Because Galaxy is more marketable, just marketable than Sony. This is why the Galaxy is more liquid than Sony. And if you look at the current assets comparing with the long-term assets, the current asset is more liquid than the long-term assets. And if you see this, when you go down, the liquidity decrease. The cash is 100% liquid cash. Account receivable is less liquid than cash. Then inventory is less liquid than cash and other current assets. So the inventory considered the least liquid assets. Okay? Because the inventory, it takes time to convert the inventory into sales, then sales to the cash. But cash is already cash. For instance, if you see the cash may be 100% is 100% cash, liquid. Account receivable is maybe 80% cash, liquid. Inventory maybe 60% as liquid. You can convert it into cash. So the characteristics of the current assets is more liquid. It is not. No, I say it is the least liquid. It is the least liquid assets. It's liquid, but it is least liquid. It means we may need more time to convert into cash because inventory sometimes may be raw materials. So we need to convert raw materials into sales or end products, then end products into sales, then sales into cash. So this is the cycle of converting inventory into cash. As similar to the inventories, the account receivable, like debtors or debts accounts. You need to collect the money from the sales, from the people, then convert into cash. The long-term assets, which includes the equipment, machines, building, plants, and intangible assets. This is long-term assets. And I said this is the investment opportunity to the business. Why it is long-term assets? Because it is for the use of more than 1 year, comparing with the current assets. Current assets is for less than 1 year. The long-term assets, we use this not to sell. We use it to produce another assets, to produce inventories, to produce the product, and so on. So the machines are for long-term investments. So you are not buying the machine today to sell it the next month. You buy the machines for investment. These machines will produce something, then you sell these products and so on. Equipments, lands, and other fixed assets. So this is the left-hand side. If you look at the right-hand side, we have the current liabilities. Again, the current liabilities is a short-term liabilities. Okay? And this short-term liabilities includes accounts payable,
notes payable,
short-term loans, and other current liabilities. If you look at both the current assets and the current liabilities, when we are managing the current assets, we have to keep our eyes on the current liabilities. Because this area is funded by this area. The current assets, go back here, this is current assets and this is current liabilities. So we fund current assets from the current liabilities. The difference between them, so the difference between this area and this area is net working capital. Net working capital. Generally speaking, this net working capital is equal the current assets minus the current liabilities. If the answer is positive, this is a healthy situation for the business. If the answer, this is, so you see, this is good for the business. Many stars. But if the answer is negative, it means we don't have stars. It means this is very bad to the business. This is a negative signs to the healthy situation of the business. So it's early indicator for the business that we may have problems or challenges in managing this this business. Okay? So the difference between the current assets and current liabilities is important to see how we recover the current assets. Yes.
That means current asset must exceed current
Yes.
liabilities.
Yeah. Because current asset. Sorry, say it again.
Current assets must
Exceed the current liabilities.
Okay, so how we fund current assets from current liabilities?
Yes.
Liability must be
Yes.
more.
We fund the current assets from current liabilities, we invest the amount, and we should process in it, and they generate more profit.
Yes.
That's the same too.
So it's this. We maximize the current assets.
Yes.
Okay, but and the current assets. Not only we should focus on the net working capital, because the net working capital give you plus or minus. To what extent a plus is fine and the minus is fine or acceptable. So for instance, if you have the green light, to what extent the green is greener? You see? Or to the what extent the red is more red.
Yeah.
So the plus or minus doesn't give you the to what extent this is positive is fine.
Yeah.
So positive, what we call positive, it's fine. So how many stars? It depends. What is the extent of positive? Let's see. Take this example here. If the net working capital is $20,000, we will see it's fine. But if the net working capital is $100,000, which is more preferable, this or this? Yes, 100,000. Maybe right and maybe wrong. So why? The policy of the business. Let's see the policy of the business. Look at this. This is, I explained this in the financial analysis. Financial managers sit in their minds what is the acceptable rate of liquidity or what is the acceptable rate of net working capital. The acceptable rate is located in the area in here. For instance, they will say, okay, this is $10,000 and this is $30,000. If the net working capital is located in this area, so it's fine. If this located to this area, it means the net working capital is like this, it is probability to go in minus. So this area is in minus. So they may put themselves at risk. So they try to keep the net working capital in this area. And if the net working capital is exceeding $30,000, what it means they have extra liquidity and they miss the opportunity for investment. It doesn't mean you have high liquidity. It's fine for the business. It means if you have higher liquidity than that's what you want, it means you are missing the opportunity for investments.
Yeah.
This is why after this part, after 30,000, we are thinking here to invest. To invest. You may invest in short or in long. It depends on to the situation. If you are keeping yourself generally above this rate, so it's fine for long investments. If this is seasonal, you know seasonal, it's fine to invest for short term. It depends on how, what is the period that you are floating above this place. If you are floating above this place for a long period of time, so long-term investment is preferable. If you are floating above this place for just season, for summer, for instance, okay, then just invest in summer and you can liquidate it in winter or in autumn. So this is the idea of net working capital. Okay? Any question? Any question for the balance sheets? So we talk about the current liabilities in the light of the current assets. Now, for the long-term liabilities. The long-term liabilities fund the fixed assets.
Yeah.
Let's just go back to this. If we talk, this is current liabilities, and here's the long-term liabilities. Long-term liabilities fund the fixed assets, and the current liabilities fund the current assets. This is what they call in management, they call this is conservative management. This is conservative management. Muhafizin. This is conservative management. The problem is sometimes we fund the current assets, the fixed assets from the current liabilities. Yes. And what we call this aggressive management. Yes. They are taking risk. This is aggressive. Why they are doing this? Why some managers, financial managers, they are funding the fixed asset from the current liabilities? Why? You know why? Why they fund the current assets, the fixed asset from the current liabilities? What is the difference between current liabilities and the long-term liabilities in terms of cost? Which is holding higher cost, the current liabilities or the long-term liabilities? The long-term liabilities. So the long-term liabilities holding higher cost. However, the current liabilities holding lower cost. So the financial managers, sometimes they prefer to go through the current liabilities. But the problem is they stress the light or the stress on the liquidity. Because in a very narrow period of time, they have to pay big money. And this is why it is aggressive. So they stress on the sales to generate more cash in order to recover the current liabilities, because they are buying machines and equipments from the current liabilities. Instead of using for 10 years loans, you are using 1 year loan. So 1 year loan, it means you are stressing on your liquidity. You are stressing on the sales to create more cash, and you may face challenges. So this is the difference between the aggressive management and the conservative management. And the long-term debts or liabilities, as I explained, it is longer time and more expensive than the current liabilities. For instance, if you go to the bank and you want to buy a house, you have two options: current liabilities or long-term liabilities. Some people, they go to the current liabilities. Okay, that's fine. But the problem is you have to pay more money in the very short period of time. Okay? The long-term liabilities, you are more relaxed in this policy. So you can easily recover the long-term liabilities and the longer period of time. So it's more relaxed in the long-term liabilities, but the problem in the lower liabilities, you are stressing yourself, you are squeezing yourself to recover the current liabilities. Okay, some managers, they do this. The shareholders' equity, which is the last one, which includes the par value of the shareholder or of the stocks, it's recorded on the par value. What it means, the bar value or the face value. Sometimes we use bar value, face value, the principal value. What is bar value? It's important to know the bar value. So the bar value, okay, and you have face value. Sometimes you have initial value. Okay. What is the difference between the bar value and the face value? The bar value. This is in accounting. The bar value of the stock. Yes. The price. When the first issue, not now. Be careful. Yes, when the first issue, the issuing a price. And it's $1 for the common stocks. Generally, it is $1 for the common stocks and $10 for the preferred stocks. The market price is different than the bar value. The market price is the actual price in the market. And there is a difference between the face value and the market value. The market value or the market price is the price in which the stocks is traded in the financial markets. But the bar value is the stock when we first issue it, maybe years. Paid in capital, the capital that's being paid by the investors, and we have the return earnings. And I explained the return earnings is coming from the income statement. Yes. The same. Initial value the same. No, be careful here. This one and this one the same. But when we say initial value, for the accountants, they consider is the same. For finance, and modern finance, they consider the initial value is something different. Initial value is the actual value of the company, of the stock, which is nobody knows what is the initial value. Is expected, or let's say, the actual value which is not observed by the investors. No one in the investor know what is the initial or what is the actual value of the business. We need to do some calculations in order to know the initial value or the actual value. You know, someone in this universe know the actual value of? No. Because this initial value like expected by the investors, and because we have many investors, okay, let's give you example of the initial value, or what this is called intrinsic value. Intrinsic. So you see, we have many values of the stock. Intrinsic value. Intrinsic value, you see, this is the market price. Intrinsic value. You see, this is the chart for, see, IBM. This is for IBM. This is the price is fluctuated for the IBM. So this is the market price. Where is the initial value, or what is the intrinsic value? The intrinsic value is somewhere in here. So this is the initial value of this. And this is the value of market, which is moving around the intrinsic value. Because nobody knows, so people are just moving around it. Okay? Is like the line is hidden, and people try to expect this line. They go above, they go below, they try to catch this line, but no one catch this. Sometimes this intrinsic value, this is in the IBM. If you look at another company, look at here. The intrinsic value is far away from the market price. So this is less efficient market. This is high efficient markets. If you look at this again, so the intrinsic value is very close to the more you are expected the price, the more you are close to the initial value. The more you are knowledgeable about the business, the more you are close to the intrinsic value.
The bar value is near the initial value?
Not the bar value. The bar value is something is in accounting. البار فاليو هي شيء بالاكاونتنج. اكاونتنج اول ما نصدر الاسهم هي بتصدر في بار فاليو. Yes. So in here is book value. You talk about the book value.
Yeah.
So the book value is the value of the stock in the accounting, in the balance sheets. If we compare the book value with the initial or the market price, okay, this is accounting value, and this is, let's say, the market value. The book value is attracting uninformed investors, because you are the first time to know this is booking value. when we evaluate the investors in the business, in the markets, most of investors, I mean uninformed investors, they are looking at accounting. They are not looking at finance. You see? So they evaluate the business based on the balance sheet, based on the income statement, how me as financial experts to know these investors are looking at this and these investors are looking at this. We estimate the booking value, book value. Most investors are looking at the booking value because they don't have knowledge on the other values of the stocks. For instance, you are the first time to know about the initial value. You are the first time to know about the intrinsic value. You are the first time to know there is a difference between the market value and the booking value. If you go to the market, you see, oh, look at the book value. You are misleading yourself because the book value is accounting value and not reflecting the actual of the business. And this way, we are measuring to what extent you are uninformed. You don't know about the business. Okay? By the way, this is not the area of discussion, but the area of discussion, what I want you to know, the stock has many values. The most important value to your level is the face value. But why I said this, just to see, oh, in the future, my teacher told me now that there's other values. So be careful. There are other values of the stocks, not only the bar value. The bar value is recorded in the balance sheets and is not reflecting the actual performance of the business. If you want to look at the actual performance of the business, you look at the market value, and then you estimate the initial value or intrinsic value, compare between them, you see how they are far away from the business, and you are decide where you go in the investments. And this will cover in investments.
Yeah.
My student in investments, they have a very luxury investment courses, and I think they benefit from this course to see the difference between the intrinsic value, and we calculate this in investments. Okay? So we explain the assets, current liabilities, long-term liabilities, and stockholders' equity. You see the amount the company received from selling stock to investors. This is the bar value. Bar value is the stated or face value a firm puts on each share of stock. Paid in capital is the additional amount the firm raised when it sold the shares. Let's see what is the paid capital and what is the bar value, just before leaving this meeting. I will give you a sample on the paid in capital. Let's see. Now, the first time the company issue shares, they issue shares by bar value. For instance, if they need $10 million, the bar value for each share is $1. So they have to issue 10 million shares. Okay? For the bar value $1 for each share, so we have 10 million shares. Now, this is, let's see, in 1990. This is in 1990, around 23 years for this company. Okay? Now we are in 2013. We want to issue additional shares. Okay? We go back to the bar value. Bar value is $1. That's fine, but the problem is, now the price of this stock is not $1. Maybe in the market now, the price is $76.
From one share value?
For the market value. So the market value is $76. It is unfair to the old investors to pay or to, let's say, to sell the new stocks. I mean additional stocks. Yeah. Be careful. The company wanted to issue additional stocks. It is unfair that newcomers, new investors, to buy $1. If you pay $1, it means me and you the same. The price is 76 in the markets. So what the accountant do? Okay, so you pay $76 to buy this $1. So $1 as a bar value, and $75 as paid capital. Paid in capital. Okay? Paid in capital. $75. So at the end, you are paying $76. So $75 is a compensation to the old investors. Yes, the compensation, because they already take a risk in 1990. So $75 is like giving them opportunity for expansion. Okay? So this is the idea of paid in capital is the additional amount. See, the additional amount, $75, the firm raised when it sold the shares. Okay? What wrong? Okay, it's not this. For example, DLK Corporation's bar value is $2, and the firm has 30 million shares outstanding, such that the bar value of the firm's equity is 60 million. If the stocks were issued to invest 240 million and 108, we will go back to this example in the next meeting. Okay, so let's just stop at 70, and inshallah in the next meeting we will carry on and talk about the example. Just remind me to talk about this example to differ between the bar value and the paid in capital value. Okay? Any question?